So now let's talk about 14.2, which is writing off and collecting uncollectible accounts receivable. So section 14.1, I want to make sure you realize, was just estimating a guess at the end of December so that we could match all our expense with our revenue related to the uncollectible accounts. So 14.2 now is that we have some awareness and understanding of which particular customers are going to be a problem and writing them off. So looking at this, we're going to journalize and write off an uncollectible AR. So canceling the balance of that account for the customer is what we call writing off an account. So we don't necessarily tell the customer that we're writing off their account because we're going to continue probably to try to collect it for a while. But once we've determined that we've heard that company XYZ is having financial trouble, they've been paying us later and later every month, and we now heard they filed bankruptcy, we don't think we're probably going to be able to collect anything. So we're going to just write off that particular specific customer's account. So when we do this, for instance, writing off Edmonds Hospital's past due account as uncollectible. So we've identified them in particular and they owe us this much and we're going to write that much off. So in the allowance, we had a balance of $2509.25. If you recall, that's what our estimate was at the end of last year. And now we are estimating that one of the accounts that actually is uncollectible is Edmonds. So we're going to credit accounts receivable for that amount to get rid of the receivable. And we're going to debit the allowance because it's part of what we estimated theoretically. So we're going to do that. Then we'll get a new balance of $1869 and a new balance of $21,203. And I'm just going to real quick pull up for you this analysis so that you can write in your notes for this section that the book value, and this is what I would write, the book value does not change when I write off an account. So before we wrote off Edmonds, our accounts receivable balance, which we saw in the T account, was $21,843.15 and our allowance was $2509. So we know to subtract that and we get $19,333.9. After we write them off, we, and in case you're not believing me, our new balance is $21,203 and $1869. So $21,203 and $1869. And our book value is still $19,333. So I wanted to make sure, because a lot of true-false questions, things like that, will ask about book value. So book value is not impacted when I write off that account. And then they went ahead and showed you as well here the accounts receivable ledger for Edmonds, where they owed us $639. We wrote off $639. So now the new balance for them is $0. So the journal entry, and this is not an adjusting entry, this is just a normal journal entry that we made in January on the 25th because we realized at that point that they're so past due and they're probably not ever going to be collected, so we're writing it off, is in the general journal, and it's a memo. We debit the allowance to reduce it because we're utilizing some of what we set aside or estimated, and we're crediting accounts receivable Edmonds Hospital. And we put that there again because when we post, we'll need to post to the general ledger and the subsidiary ledger. So let's just flip through that real quick. Nothing that dramatically different there. So then posting, they've shown you as well, and it is not going to be any different either than you always did. So post the date down in the green is the general ledger, and again, you have this handout if you want to take notes on it. The green is the general ledger. The blue is the subsidiary ledger. So we put the date down there for accounts receivable and the allowance and in the subledger. The only difference is in this subledger we write written off so as to specify what we've done, that it's not just a normal entry and they paid us, it's that we're writing it off. And then you put the post reference like normal. The G16 comes from the general journal, G16, and the debit and credit amounts. So it was debited to the allowance and it was credited to accounts receivable and also in the subledger. Calculate new balances like we've done 5 million times, and then put the post references back up there. And if you recall, again, the general ledger post reference goes on the top of 1130, and then the account from the subledger, the customer number 120, goes up there on the bottom. And then we did the 1135 for the allowance. So then it's feasible that we would end up writing them off, and turns out they send us a check and we collect it. So when that happens, we have to write or reopen an account that was previously written off. So we receive full payment of their account that was previously written off as uncollectible, $639. Memo 71, and the receipt showing that we did it. So what do we do in this case? We end up, we're crediting the allowance and we're debiting the receivable. So we're basically reopening or reinstating that balance. And I like to see it more in journal form. So we receive cash and payment. So what we're going to do with a general journal entry is debit the receivable from Edmunds for that amount and credit the allowance. And then we're going to turn around and record the cash that we received like normal. So go to the cash receipts journal and debit cash for the amount we received, credit receivable with their name and the document number. So record the cash receipt just like normal. So initially we reverse and reinstate the receivable by debiting it, and then we collect the cash and credit receivable. And then the posting, I'm not going to go through this again, but it's the same as you always do on posting these things to the general ledger and the sub ledger. So nothing new there whatsoever. The only thing is we write reopen account when we reopened it, because if you recall, we put written off when we wrote it off, put reopen when we reopen it in the subsidiary ledger. And just so you know, the book value stays the same again as you would expect.